Please welcome the panel on credit markets, new risks, new game plan. Moderated by CEO of the Algorand Foundation, Staci Warden.
Hi, everybody. Thank you so much for coming here. You are in for a treat. This is a heavyweight panel right here to talk about, I think, probably the most important financial topic of the year. You know, what is going on in credit markets? What's going to happen in credit markets? Where are we in the cycle? What does it mean? What is it going to mean if we're sort of higher for longer? What is it going to mean if the Fed starts cutting? And where are your, pension funds going to put their money? Where are you going to put their money? And the kind of structural shifts going on. It's about kind of the King Kong of banks against the Godzilla of private markets, and we're going to see how this all plays out and who is going to win the battle for total world domination. So strap in, ladies and gentlemen. Let me start with you, Jeff. Everybody, if it's relevant, say where you are. That's relevant to all of you, and then say how much money you have. I don't mean that personally. I mean that institutionally, if it is relevant. Okay. So, Jeff, you run global research at Barclays. What is going on? The Fed has done, I think it's 11 hikes since 2022. They took away the punch bowl, and the party is still going on. Like nobody cared about the punch bowl, I guess. And so can you kind of paint a broad global landscape for us in terms of the global and the monetary and where we are in the cycle, in your view?
Sure, of course. Thanks for having me, of course. And this was a little bit more of a Marshall setup than I was expecting. So I guess we're going to really get after it here.
Yeah.
We are very much in the soft landing camp. What that means for us is a gradual slowdown in activity. And eventually, the interest rate hikes starting to have their intended effect. As you mentioned, most of the entire professional forecasting community got wrong how quickly the U.S. economy would be subject to slowing in the face of a nearly historic rate of interest rate hikes. There's a large number of reasons we think why that hasn't happened. A number of reasons why the economy is less sensitive to interest rates today than maybe we are trained to believe. Probably the most important in our view right now is the substantial deficits that the federal government is running. Something like 7% of GDP, which means upwards of 4% above what would be a sustainable long-term rate. That's effectively shadow fiscal stimulus, which we're very much enjoying, and I think that has been showing up in a lot of the activity numbers. I don't want to overread the more recent data. Obviously, this data is very high frequency, but there's maybe some signs lately of the economy coming off the boil just a bit, still strong, but maybe not accelerating. Our expectation is that process will continue, but not that we would expect a recession in the medium term. Instead, what we're expecting is these interest rate hikes will eventually start to bite, and you'll see some slowdown, some modest increase in the unemployment rate. However, companies, particularly issuers, are reacting to these high rates. They've had plenty of time to get ready for them. And so when we think about, in particular, say, the investment grade landscape, we see limited scope for market consequences from this slowdown. Last year was the largest year on record ever for upgrades from BBB to single A in the investment grade market. That's because companies are preparing their capital structures to be better equipped for this new high rate environment. And I think that's a process that will continue. And of course, in the high yield market, there may be less flexibility. I'm sure we'll talk about the potential for volatility there. But overall, the biggest players in the U.S. economy are well positioned for this, and we think have already started to take the steps necessary to restrike their capital structures.
Okay, Jeff, let me just push on you one more round, because I and sophisticated members of the audience are, of course, listeners to the Flip Side podcast. And you have argued on that podcast that the Fed really didn't have anything to do with anything. It's kind of completely irrelevant. Do you want to explain that view to us?
Yeah, sure. So I wasn't expecting that one, but that's good to know that our podcast is making it out into the ether. So I think there's a large number of reasons why the economy didn't react the way forecasters expected. I mentioned the deficits being one, but I think there's a long list of reasons why higher interest rates have not had their intended effect. And some of those are structural, just the way our economy is built right now. We're a services economy, which is services are less interest rate sensitive than manufacturing. There's a structural shortage of housing in the economy, whereas usually the housing market is the place where you see interest rates bite first, and you see a lot of construction job losses, house prices fall. That really didn't happen this time around, even though mortgage rates shot up in the face of the Fed action, and that's because there's all this shadow demand for housing out there because we're structurally underbuilt. And so these are just two examples where I think the sort of impulse from Fed hikes and then the reaction in the economy seems to be broken, and that's really slowing this, which is why we're still not forecasting a recession. That's why we're still forecasting soft landing, and just the economy sort of normalizes its glide path.
Okay, I'll sort of circle back to that at the end of the panel, I think. But Steve, let me first turn to you. First of all, how much money are we talking about? How much money do you have?
Guggenheim manages around $300 billion for a mix of institutional clients, namely insurance companies, then large pension plans and the like, and then a growing intermediary/retail platform. So anybody can be an investor, including someone in this room.
Okay, is CalPERS a client of yours?
I was hoping to talk to Jean about that afterwards.
Okay, so I think Jean
Not
and I did speak before, and she said if you do a very good job on this panel, she would be willing to reconsider her allocation.
To take a meeting?
To take a meeting,
over Zoom?
exactly, yeah.
Okay.
So when I think of kind of going from the macro, maybe one step down,
Sure.
How do you think about kind of the landscape of credit markets? You know, on the issuance side, on the investor flow side, paint the picture for us a bit.
Yeah, as Jeff articulated, it's been an interesting reaction in the last 2 years of what we thought were historic rate hikes and changes in rates. If you go back to 2022, you obviously had the buyer strike. Essentially, you had no issuance in anything. Investment-grade corporate markets tend to be less reactive to the overall macro environment, so there was a normal amount of issuance there, but in below investment grade, across high yield and loans, securitized, there's just very little issuance. Last year started that way for the first half of the year. Then, frankly, the second half of the year was much more open for issuance as spreads started to tighten from their wides, as obviously the Fed changed their kind of overall sentiment and statement around when they would theoretically start to ease policy again, which really opened up essentially the new issue floodgates for this year. So investment-grade corporate issuance is tracking at around 1.4, 1.5 trillion, perhaps. About 600 billion so far issued year to date. About half of that is actually net new issuance. What we're seeing in investment grade is issuers have come around to accepting the cost of capital as where it is. If you're an investment grade issuer, on average at the index level, you're paying about 4% based on your debt that you already had outstanding. Now, when you take on new debt, you're paying around 6%. So to help contextualize the change in interest rates and what it means, it's a significant percentage change, but it's still overall tolerable. And we're in an environment too where there's a lot more long-dated fixed rate debt. If you think about pre-financial crisis, commercial paper outstanding was the same as investment grade bond outstanding. They were about half and half. So issuers would feel the brunt of interest rate changes right away. So what that means is that the cost of interest has been slow to make an impact on issuers. About 10% of the IG market rolls over every year. So if you were to just restrike their cost of capital to what it is today, it's that 4 to 6 trajectory, which issuers have been able to tolerate. Frankly, top line revenue has been growing much faster than interest expense. When you get a little bit lower in the quality spectrum is where you start to see a little bit more stress. High yield markets wide open, and issuers are actually moving from the syndicated loan market, or even in some cases from the private markets, back to high yield, because with a downward sloping yield curve, they can save a little bit on interest expense by going out the curve. So that's where we're starting to see a little bit more of the change in fundamentals. Still overall, it's been well absorbed, but the impact to earnings, the impact to coverage ratios is definitely further felt. The lower in quality you go, or the more leverage that you have. But
high yield credit have also, the spreads have been pretty low.
They have.
Right?
They have. So to use that same example, in IG issuers were paying 4%. Now they have to pay 6%. High yield, that average coupon got down to about 5%, and now it's migrating back closer to 8%. So on a spread basis is where issuers are thinking that now is an okay time to be issuing. And in fact, we're seeing a lot of issuers in both markets issue and sit on cash. You're seeing that particularly from crossover issuers from that need dollar funding, particularly from Europe, because when we talk to our clients and constituents around the globe, the number one concern for the rest of the year is the election. So we think we've seen a lot of pull forward in new issuance, even despite these relatively higher yields and because spreads are relatively tight.
Why would they be concerned about the election?
Yeah,
I
well,
can't.
it's
I
just-
don't understand where that could come from.
That's not this panel.
Okay. Let me go back to you though and dig in a little bit more. So you have talked about the effect of rates on issuance, I guess. But if you peel back to a more fundamental level, what's the effect been on earnings? And
Earnings impact has been muted so far, particularly for high quality issuers. There are certain issuers that are even paying essentially negative interest expense because they can borrow at around 5.5 and sit on cash and earn 5.5. So the optionality that they have from issuing capital in this environment where now there's a broader acknowledgement or an acceptance that interest rates are not going to fall materially from here, and when spreads are relatively tight, has led to this flood of issuance. And you brought it up, but I haven't answered it yet. When you talk about flows, capital flows are still very strong.
Yeah.
So you have fully funded pension plans that are looking to de-risk. You have retail money that's been on the side. You have kind of a dearth of credit opportunities, frankly. I think that's what's driving some of the tightness that we've seen across all of these markets, is there's not a lot of net new credit supply. But so areas that are doing...
let's go sector by sector in the next round, but let me turn now to Jean. As an investor, first of all, how much money do you have?
We have a little bit of a small balance sheet, roughly 500 billion.
500 billion.
It's all CalPERS money.
500 billion, and you can't give just a tiny little bit to Steve to
Yeah.
manage?
We will see how he performs.
Oh, let's see how he
Staci,
did.
you are my new best friend.
10%. That's all I ask. But tell us about kind of investor flows from your perspective, Jean. Like, how do you see as an investor? How do you see this landscape? And on the one hand, I could think a very easy or a very simple answer could be, higher interest rates are great for investors, but it's a little more complicated than that, I think.
Yeah, we actually I don't mind having like higher for longer. And the reason
Why is
is that it actually allows us to de-risk. So if you think about when we were in low interest rate environment, the reason why we have to reach out to do private credit instead of public credit is there's no return, right? So we will have to use a lot of leverage in order to get to, even at the junk level, get to whatever our actual rate of return is. Let's just use like 7% as an example. Okay, so reach 7%, if you think about before the interest rate rise, it's basically you have a base rate of close to 0, and you have a spread of 450 on the even on the private side. So you get to 5-6%. I have to use back leverage inside the vehicle for about like 1 or 1.5 turns in order to get it to roughly 8%, and then after I pay the fee, I'm right at 7%. Right? But right now, the base rate is so much higher, so it allows me to de-risk in two fronts. The first one is, okay, I don't have to use that much of a leverage on the back end. The second part is that I can actually consider, doing like a little bit up on credit quality. In the past, we have to deal with like highly levered junk grade companies. Right now, hey, can I consider, up in the credit spectrum? Maybe even like investment grade. These are all possibilities.
Yeah, this is, we're at the Milken Institute, so junk is not a bad word here. I just want to remind the audience of that.
Oh, sorry.
But Jean, you started on the public side as an investor, and now you're a private credit investor. I don't know if you've gone to the dark side or if you've finally seen the light. I won't pass judgment on that, but how are you thinking about, maybe to move it a little bit more structural, how is this environment, what are the structural kind of impacts of where we are now in this cycle on kind of public versus private credit?
Yeah, I think I'm very lucky to have a public background and then migrated into doing private, so that I have a view of more of like private debt should be a mirror image of the public debt, with the exception of the treasuries and the sovereigns.
Okay,
right?
explain that.
So it should be like, you have corporates, which is like investment grade, high yield, and the leveraged loans. On the private side, you have, in the past, it's middle market direct lending. And then people back then, let's say in 2015, 2016, when people talk about private debt, private credit, it means middle market direct lending. But the market has changed so much, and it evolves. In 2018-19, you started to see more people engaging in that area, more managers. And then right around like 2020, we started to see the opportunity of like large companies. They're actually, especially on the sponsor side, large companies that they get the taste of how flexible that they can work together with the private lenders. So private lenders migrating up. Instead of the middle market of like 50 million EBITDA go to 100, 200, and then we see a billion EBITDA company doing that. That for us is great opportunity because for CalPERS balance sheets, we have to have things which is scalable so that we can move the needles. It is impossible for me to, collect a whole bunch of like 50 million. I need something which is like maybe 500 million.
Yeah, you can't be more than 10% probably, or you have some kind of rule like that.
Yes,
right?
there are lots of rules, but we want something which is scalable. Yeah. So for us, the market morphing is like very, very interesting. And then so that's on the corporate side. And then you have mortgage, right? Residential mortgages. You have on the public side, you have Ginnie Mae, Fannie Mae, Freddie Mac. In the private side, you have all the non-performing, reperforming, non-qualified mortgage. And then also everything before they securitized to the Fannie and Ginnie of the world, right? And then the next one, you look at the CMBS side, the commercial real estate. Public market has CMBS, and in the private, you have everything that the insurance company holds on their balance sheet. And then you also have all the regional banks doing the lending. So those are all private. Transitional property is also another one. And in the very last sector, you can think it as if it's the equivalent of the ABS market, a specialty lending, asset-based financing.
Right.
Everything securitized, credit cards, student loans, autos, containers, cell tower. And then right now in the private, you see a lot of similar things like that, warehousing on solar panels. And basically everything before securitization. So if you look at this 4-block, and this is also how we construct our portfolio, this opportunity is huge, especially given the bank retrenchment. If you say that the corporate side, the direct lending is in a baseball inning like in the 7th or the 8th, the ABF of the war, and then even the real estate is probably the first and the second only.
Yeah, okay, that's interesting. Okay, but Meghan, you are with Fitch Ratings, of course, and you have been covering NBFIs for how long?
18 years.
18 years only, so I guess you know something about this. What has this been kind of a uphill climb for the last 18 years, and do you expect that rate of growth in private credit to keep going? Talk about what has driven kind of the growth to date in your view, and where do you expect it to go, just kind of at a structural level?
Sure. Yeah. I mean, when I started, it's interesting that private credit is so topical today because in our view, it's kind of been around for a long time. Non-banks really is kind of private credit. When I started, it was a lot of captive finance companies, but we rated business development companies back then as well because they've been around since the 80s. And so it has been a slow climb, but there's been some instances in history that have accelerated that growth. So certainly the GFC, bank retrenchment with regulation. We saw some significant growth in BDC creation in particular coming out of that period of time, but also the alternative investment managers in particular. So we started rating them in 2009. Back then they were called private equity firms because that was the majority of their business. Now they're really credit shops, but they're called alternative investment managers. So they have driven a lot of the growth in the sector. And to Jean's point too, in terms of being able to do billion-dollar plus deals, it's because they've attracted so much capital. And they've grown. They can internally syndicate across SMAs, funds, BDCs, you name it. And they've also developed further with these tie-ups that they have with the insurance companies as well. So you have Apollo, KKR that own insurance companies outright, as does Brookfield. And then you have others like Blackstone who takes more of a balance sheet light approach, but is affiliating with insurance companies. And so they are developing rated product for insurance companies. Direct lending, I would say, I agree, it's in a later inning. I would say, though, it's still probably in the first half of the game, if I had to guess, actually, because just given the growth that we've seen and we expect to continue to see there. But you're right, ABF, I think, is the hot topic today in terms of what they're creating. Apollo owns a dozen, plus of originators themselves. They can eat their own cooking and move that to Athene's balance sheet and other funds that they're managing, and others are following suit as well. So I agree, real estate credit, infrastructure credit, ABF, early innings there, and we expect that to be considerable growth still. I think there's lots of debate about the size of the private, credit space. We hear everything from 1.4 to 1.8 trillion, but based on that data, I think Preqin's talking about 2.8 trillion in 4 years. So according to them, big data provider in the space, lots of growth still to be had.
Let me ask you a macro point, if you don't mind, because you're, I think, a little bit closer to mid-market. Maybe how is the health of the mid-market in terms of the rate environment? It's kind of the parallel question that I asked Steve. Yeah.
Yeah, I would agree with Steve, because I do think as you listen to the BDCs in particular, they're still talking about EBITDA expansion. Modest, it's coming down in terms of the growth rate, but it's still there. We have some indexes that we follow that track that as well. Certainly interest coverage, though, is an issue. So Ares Capital, one of the biggest BDCs, interest coverage was over 3 times end of 21. Now it's half that. So at some point, the pressure is going to turn into a bigger credit issue. So I think we started 2022 expecting to see some more credit deterioration in portfolios. Really didn't materialize. And now, as we ended 2023, started to see more differentiation in BDC portfolios in particular. So that pressure is, it's been a pressure cooker for a period of time. But the good point is, having these bilateral agreements oftentimes with the private credit providers, there's things you can do to kind of renegotiate, push things out a little bit. But is higher for longer is going to continue to create pressure, especially for that bottom part of the portfolio.
Okay, so after that setup, I want to talk about kind of 2 big areas. One is this public versus private, and what should we expect? And how can we find an equilibrium there? Is there an equilibrium to be had? What is pushing one way and the other? What is that going to look like? Where are the opportunities? And then I want to go kind of sector by sector and get your views sectorally. So, banks are also taking deals from private credit facilities now, right? There's really like a fight on, and the revenge of the banks, I will call it, the revenge of Godzilla coming back. And sponsors are kind of dual tracking these things as well. So how do you guys see the kind of the investment thesis at play that explains that, and where do you think it'll go?
So let me take a stab at this, because I think what we're seeing in a bigger picture framework is what I call the equitification of credit. We just wrote a big note about this.
The what of credit?
The equitification, which is a terrible word,
I don't think it's a word at all.
Maybe it's made up. I might have just made it up right here. But what we mean by that is that the credit market is developing some tendencies that we more naturally associate with equity. So I'm actually going to start away from private credit first, and I'll link back to that trend, because I think there's really sort of 2 sides of this coin.
Go for it.
What we started to see around 2018 and 2019 was high yield and leverage loan mutual funds using ETFs to manage their liquidity needs. So fixed income ETFs are extremely liquid. They trade very readily in the secondary market. And you can imagine that instead of holding cash or treasuries, you could own some high yield or leverage loan ETFs, which earn yields like your benchmark, and you can trade them very actively to manage your inflows and outflows. Very shortly after that started to happen, we saw the advent of portfolio trading, which is a brand new trading protocol in credit. We think it's upwards of 10% of the total volumes in the credit market today. And it's basically like a way of trading bespoke portfolios, like bespoke ETFs almost. And actually, the portfolio trading desks use the ETF market to hedge and price portfolios. So it's a very symbiotic relationship.
So not secondaries.
It's no. This is secondary trading of high yield bonds happens in this like new protocol that is way more efficient, has like 40% lower transaction costs than voice trades with your favorite high yield trader, right? And so what does that mean? It means that the urgency with which you worry and manage your liquidity needs as a high yield mutual fund has gone down quite a bit. It's a lot easier to manage inflows and outflows today than was the case 5 or 10 years ago. But with that, we think comes a lower liquidity premium in public credit. So you mentioned earlier the tight spreads, for example, relative to investment grade. We estimate that 50 to 100 basis points of that is due to a reduced liquidity premium in the public high yield markets because it's easier to trade that. Now, put yourself in the shoes of an endowment or an insurance company or a pension fund, and you would say, do they trade every day? No, they don't need to trade every day. They were basically free riding on that liquidity premium. It was a source of extra return for them because these mutual fund managers needed it in order to be able to justify all the inflows and outflows, right? So they needed that extra return. So now those are exactly the investor base that is starting to move into these more private assets. That's where they can get that incremental yield, effectively looking for that liquidity premium in new places. And I was expecting, wrongly, say this time last year, that by now we would have emerged from this private credit fever dream, and higher interest rates would have meant we don't need to search for yield and lever things 10 times like what you were saying, and we would have all gone back to public credit. But I was totally wrong. And I think the reason why I was wrong is because of this liquidity premium dynamic. And so what you're seeing is the development of a very robust private market in credit. Again, something that equities has had for a really long time. And with the development of that robust private market, investors now have an ability to more finely tune their investments based on their needs. So if you really need a lot of liquidity, you move into the much more liquid spectrum, right? Where you can use all these new fancy tools and do all sorts of new sort of higher frequency, not quite like true high frequency, but systematic trading strategies, et cetera, in the public market. But if you don't need all of that, then you go into these other new emerging asset classes, which are growing very rapidly. And they're growing rapidly precisely because there's a big investor base that doesn't need to do all that trading. And so they look to this, to these alternatives. And I think that it's something that the equity market has lived with for many, many years. There's private equity, there's public equity. Investors choose the markets for different reasons. Issuers choose the markets for different reasons. And I think that's where we're very quickly approaching that kind of an equilibrium. Exactly what that means for the sizes, I think probably depends on availability of financing in the two markets. It depends on whether or not we have a credit cycle, the performance of private assets during that credit cycle. So I think there's a lot of unknowns still, but this cat is not getting back in the bag, right? Like, it's out there, and we should get used to the fact that now issuers and investors have a much richer set of options in front of them, and they have to really think more carefully about how to position themselves.
Equitification, ladies and gentlemen, you heard it here first, okay? When it's in the Wall Street Journal, I want you to remember where you heard it first. Gene, as our resident investor, do you agree with that? I mean, he's basically saying, the liquidity premium is driving all of this, to simplify, of course. But what do you agree with him?
Yeah, let's take a step back. Okay, so earlier we talked about, is it a Godzilla and a gorilla, right?
King Kong and Godzilla.
Yeah. Okay. You have to think about, I think the private equity sponsors, the borrowers, they are the most sophisticated investors, right? So majority of them right now also have dedicated desks to cover the capital market. So they will find the most efficient way for them to finance their portfolio company. So if the public market can give them the best execution and the public market is open, they go for the public market. Even the middle market will migrate up into the broadly syndicated market to get a better execution. But if they need some optionality, flexibility, they want to have add-ons, the private lenders are their only choices. The public market gives you a plain vanilla, very simple things. Cheaper, yes. But if your strategy is not just sit there and grow your business, you want to have like merge, acquisition, add-on, or some strategic purchase. Private market, private lender is your best choice and your best friend. And then the private lenders, I think throughout the COVID, people understand that for public market, if you need some extension, you need some modification, you're talking to 1,000 people. How can you achieve that? Not going into default. Yeah. But in the private lending, you talk to your 1 or 2 or 3, and then you get very commercial terms. You may have to up the coupon a little bit, but you get people work together as a partnership to get things done. So I think this is very, very different dynamic versus where we were in the past. And then for that reason, I think the two big monsters will coexist.
Yeah, I was going to say that I think that's your point on dual tracking in terms of covering the sponsor. I mean, these guys are doing deals with each other all the time now. Carlyle is financing Blackstone deals and vice versa. And they know the sophistication of each other's platforms as well and the depth of the dry capital, the dry powder that they have in their platform. And so I think to Jean's point, we talk to the sponsors and we say, hey, if the syndicated market is open, is that where you're going? And they say they're dual tracking every transaction regardless of size, because sometimes it is they just want the best execution and the cheapest price. Other times it is important that they have privacy, that they have flexibility, and add-on in particular is super important to have that availability and that capital if they're doing roll-ups and want to add to that investment over time. Having a private credit solution oftentimes is more important, even if it is a little bit more expensive.
I think the more interesting kind of evolution coming up too will be the assets that are on bank balance sheets that are going to migrate to whether it's through private or public issuance to other investors, because
capital relief trades. Talk about
not
that.
every private credit investor wants to lend at 100 over or 200 over. In fact, none of them do. So it's form fitting the investment opportunity and the capital needs. Not everybody wants to borrow at SOFR plus 500. So it's marrying where has capital gone, clearly more into the private ecosystem. Where is it coming from? The banks. Who are the underlying and ultimate asset owners at the end of the day? It's CalPERS, it's insurance companies. But each one of them has a different need for what structure is put around that. So I think you mentioned a number of the securitization evolutions, if you will, or flavors that are out there right now. That will probably be the next stage of this as well. To how do you make it capital efficient for the asset owner to take that capital from a bank who's financing themselves now very differently and has very different rules than the very people they're competing against.
Yeah.
Okay.
And then so now comes to that
It's a terrible word. I said that at the beginning, yeah.
Yeah. So I do agree with him that it's the illiquidity premium is driving us to allocate to the alternative area, like all the privates. We used to have like 20% in non-public assets. Right now, we are migrating into close to 30 to 40%. And we're even thinking about if we don't, we say that CalPERS is a long-term, investor, right? So if we don't need that much liquidity, can we allocate more? And liquidity itself is a very interesting concept. For people who lived before financial crisis, liquidity for me should be like credit card. I can cross it with 0.5 basis point bid ask. That is liquidity, right? Right now, it's impossible. Right now, like even if you want to sell an investment grade, what is the bid ask right now? If you want to do, let's say, 500 million.
Well, Jeff's telling us it's zero now, just in a portfolio.
Well, I think that's to be clear. It's actually quite right. So I'm not saying it's zero, but what I would say is you could short an ETF and pay less than 0.5 basis points. I mean, you basically get that at mid. And so there's tools out there to effectuate big transfer of risk where you don't have to do the hand-to-hand of calling up, 15 different dealers to get quotes on 100 bonds each. And if you had a bespoke portfolio you wanted to do, you can ask 5 dealers to price that bespoke portfolio, and they give you a price very close to Bloomberg mid, something like that. So there's actually quite a number of tools that are being developed where that's not to say that you can trade any one individual investment grade bond that cheaply, but rather to say that if you have big positions in investment grade that you need to transact, you can do that relatively cheaply now using some of these new protocols.
Okay. As much as I hate to interrupt the love fest between Godzilla and King Kong over here on my panel, let me pose the following kind of situation to you. Private credit follows private equity. We have a very muted M&A environment right now. There's not enough deals to go around. There's a ton of capital out there. We are already seeing the degradation of kind of covenants. We are about to enter a very frothy market. It is not the case that we are just kind of spreading risk around. Actually, we are creating another kind of crisis situation that none of them look like the last one. So what say you to that?
To that risk?
What, do you agree with me, or
within the private markets in general?
Yeah, like private markets. Mike Milken used to make this joke that he was going to start a PICS anonymous group,
right,
where you could just come and confess your PICS sins, and in an anonymous way,
right,
and
Well, I mean, capital's kind of only gone one direction into the market more broadly. It's been a very benign fundamental environment, despite all of the volatility and all of us being wrong on all our predictions. It's gone generally well. The higher for longer is a challenge, to people who are paying high levels of interest. There are stopgaps you can do, but there are going to be just broken capital structures and business models that there will need to be a readjustment. The good thing, though, about the private ecosystem is that it's like a better designed bank at this point. The capital that goes into it can't be taken out very easily or quickly. And even when it comes time to take it out, there's a lot of levers that the aggregators of that capital can use to kind of delay it and make it at a more opportune time for them. So it really is long-term capital and long-term investments. No pun intended with the long-term capital. So I think that reduces the systemic risk of the whole ecosystem. But it's going to go back and forth. I mean, issuers, like everybody's been saying, they're not wedded to any one market. They are going to do what is in the best interest of their company or their fiduciary responsibility to usually minimize the cost of capital. And that'll make private markets even more competitive. It'll reduce pricing. It'll eventually reduce that liquidity premium. The easier it is to access the market, maybe the liquidity terms change of the vehicles you're investing in. Like it does speak to an environment where the spread and opportunity set will ultimately compress.
Very benign answer. Megan, do you agree?
I do agree. I think there's a little bit of been there, done that. I mean, I think some of the situations in terms of the backdrop is a little bit different. But I mean, coming out of the GFC, there was certainly, you had this very long benign period of credit, but it got so competitive that spreads were super tight, covenants were starting to lose. So we've kind of been here before. And I think the good news is right now we've been in this situation over the last, they had like 6 or 7 quarters, a lot of the private credit originators, of really good spreads and really lots of excess income, which is helping to cushion what could be coming in terms of more pressure from credit deterioration. So you're right. I think there is the dislocation between supply and demand because M&A is so muted right now, but I think everyone's fairly confident it's going to come back. I mean, Mike Arrighetti on his earnings call, who's the Ares CEO last week, said, generally speaking, invested capital in the ground and dry powder is at equilibrium. Right now, it's 3.5 to 1. So you have 3.5 times invested capital versus dry powder. That has to shake up at some point. Right. That's going to drive volume because LPs, and Gene in particular, needs your capital back, right? So you can re-up to future funds. So at some point that has to shake loose, and that will start to drive more activity, and that will help with the supply and demand imbalance for sure. But there's still more and more capital that's coming into the space.
Anybody else have anything to say about that before I move on?
We did see that the deployment of the portfolio become much, much slower than expected for the past 12 months. Yeah, so what we were doing is, we try to go to different areas. As I say that, there are different buckets, like different categories, right? So corporate earnings, you have too much money chasing it, the spread tightens. Okay, let's stop, deploying there, then go to like maybe ABF, maybe, the next one, maybe real estate lending, who knows?
Okay, let's talk about sectors. Steve, let me kick it off with you. Give us a broad overview. Where do you think, how do they look, kind of maybe broad sector by broad sector, and
Yeah, I mean, in general, there's not a lot of cross-sector dispersion in what we're seeing in fundamentals.
You don't think there? I thought there might be.
I mean, outside of, I'll get to the real estate and the few where there definitely is. But you're seeing more intra-sector dispersion, which gets back to the point of, really leverage and bad capital structures. So not the cliche, there's no bad business, there's bad capital structures. I mean, there is both.
Your grandparents told you that when they were rocking you as a child.
Yeah, they said one day you'll be at the Milken conference. They'll say that. But I think, so areas where we're seeing some stress, I mean, some of it's public information, large public issuers, communications, cable, some of the big melting ice cube issuers. And I know we said we wouldn't talk about restructurings and distress situations, but
no, we can later. But let's.
So that's one area where we're seeing it. Healthcare too, where you've had a lot more wage inflation, and the costs in that capital structure are more tied to inflation and services. Real estate is really the top of mind one. Commercial real estate in particular, obviously office. I mean, that is the intersection of a complete change in the cost of capital and then some big structural and cyclical headwinds that the the middle is not good. So, but fortunately in that ecosystem, it's mostly bilateral, and essentially everybody's incentivized to kick the can down the road. But we are seeing very material losses on office in particular, and usually it's at maturity. And up until that point, there are certainly warning signs, but that is kind of the bigger, broader risk that we're seeing across all the markets.
And on the commercial real estate, how do you see this shaking out? Although, I mean, I will say I personally am somewhat excited about my ability to buy a nice 5-bedroom apartment. I mean, there won't be any windows, I guess. There'll be a copy machine room,
Sure.
in my kitchen. But you
can go live in conference room 8.
I can go live in conference room 8.
Yeah. It's going to take a while, and it's going to lead to a lot of losses. I mean, that's why, from a positioning standpoint, we're interested in trying to position ourselves as opportunistic, and our CIO is in the process of looking at launching a real estate and infrastructure fund to capitalize on that. But really, the supply is going to come from bank balance sheets, most likely, and so that is the intersection of concerns for us right now.
Mm-hmm. What else? What are you guys worried about?
I would say in some of the BDC portfolios, for example, software tech is one of their biggest exposures, and generally speaking, that's performed really well. I think the wrinkle in there is just the recurring revenue loan structures, which is still somewhat untested. It was a very competitive environment throughout the pandemic because software was performing so well, and we're starting to close in on some of these flip structures where you go from revenue-based covenants to EBITDA-based covenants. So they're very dependent on lots of cost cutting and making sure that you can generate EBITDA to kind of meet those covenants. So I think we're at the early stages of seeing some of those conversions. So I think that's something to kind of keep an eye on for sure.
I think that's very interesting because the one of the initial, I think, impulses around the growth of private credit sort of from that 2016 period through COVID was the search for yield, right? Where banks were constrained from underwriting deals that were too levered. And so it's not necessarily intrinsic to the private market that this is true, but there does happen to be some more aggressive capital structures sitting there, and the higher rates coupled with potentially higher for longer with maybe a modest landing in the U.S. economy could be a dangerous combination, which we have so far not tested that, right? We've had the higher rates, but we haven't actually seen the economy start to slow. And so if you get that, if you don't get the rate cuts to materialize, but you do see a somewhat softening in the earnings growth picture, we'll start to test some of those capital structures.
Yeah. I mean, inflation's been broadly good for credit, right? Like everybody's been able to generally grow margins, generally grow the top line. To your point, if that goes away, or if you see the economy turn around, and that's what another concern is the consumer in some ways. I mean, you're seeing delinquency rates for 22, 23 vintage in unsecured loans that are outpacing what you would have seen in 2007, 2008 for the same time period. Although you contrast that with an unemployment rate, sub 4, whereas the unemployment rate was, approaching 10 at that point.
Yeah, I mean, Ken Griffin earlier said, ladies and gentlemen, just to be clear, we have not killed the business cycle.
Right.
Here, right? Like this time is not different, right? But maybe this is a good time to talk about kind of some distressed sectors. So according to S&P, a tier 2 ratings agency, the 62% of speculative grade debt and loans and revolvers, the problem is that 60% of these sectors, entertainment, consumer products, healthcare, retail, restaurants, have been in floating interest rate kind of revolvers, right? And that 55% of all defaults are coming from these top 3 sectors. And so is it really that there are some sectoral issues with certain sectors, or is it broader than that? And how do we think about that, the kind of the structural element of some of these? Where is the maturity wall coming? Where is there a default, like a structural default cliff that we should be worried about?
Well, the generic answer is no, from a credit panel, people with long credit risk. But to your point, floating rate borrowers are, of course, feeling the brunt of higher costs of capital first. Now, getting back to the new issuance theme from earlier in the year, you've actually seen the cost of capital go down for a lot of those issuers who are performing. You've referenced a cohort that's not. So you're probably at peak, at least we all hope, short-term rates, and spreads have tightened in. So the all-in cost of capital for floating rate borrowers has gone down, for the first time in 2 years. It's still an elevated level. I would say the big structural one is back to real estate. I mean, you just have a complete mismatch in cost of capital and investment return, and how that's funded. Typically for 5 times levered, if you will, if you want to think about it that way, or like an LTV of 60, 70, 80. And it doesn't take much of a change in something that's inherently very levered to its earnings to get through the attachment point for the debt.
I think it's a really interesting point, because going back to what Jean was saying earlier about the dynamic from the issuer standpoint on choosing which market to go to, right? Actually, from the standpoint of being able to manage through a difficult capital structure, but an underlying business that makes sense, all of these options makes it great, right? It gives you a lot more flexibility. And you can use these options to restructure in a clever way if you need to go the private route, or, there's all sorts of just directions that a company can take, so long as the company makes sense, right? But your point about the real estate is there's no restructuring out of this, right? There's no clever capital structure you're going to have for
an empty office building.
That's right. An empty office building generates no rent, so there's nothing you can structure around that. And that's where I think you're likely to see greater pressure.
Yeah, and then Staci, I agree with you that we worry a lot about the issues that you talk about. So when we are choosing GPs, that we emphasize a lot on their workout capability.
How's your workout capability?
Yeah, we were talking about that before.
Because, there's a very fine line between, Jeff, between clever restructuring, liability management exercise is kind of we're in polite company here, so I will call it liability management exercise, and a coercive exchange, right? Yeah. So
it's actually easier done in the private market versus the public market. Public market, you will have to cost a lot, like lawyers' fees, maybe go to the court, and a lot of this high cost things. In the private market, you talk to your lenders, and then, or you can find somebody who can do your capital solution. So as much as the interest rate is very high, and then the burden for borrowing the floating rate is, interest expense is high. However, it is still cheaper than whatever the equity cost for that sponsor, right? So the equity sponsor is buying time that, okay, I will borrow for this year, next year, a little bit of a higher interest rate, but hopefully my business can grow out of it. And then it is still cheaper than my cost of capital in the equity fund. It is still accretive to their return. Yeah. So in the private, I think it is way easier to working towards the common goal, and then to try to cut cost on a lot of the waste in terms of dealing with the bankruptcy court and then dealing with 1,000 investors.
See, I think it might be easier, and I take that point, that the negotiations may be easier, but I think the fundamental trade-off that's happening in the two markets is probably very similar, which is one of effectively buying yourself time through these sort of structural nuances to be able to ride out to the point where you can kind of grow into your capital structure, right? And so you mentioned coercive exchanges, like a fine line. Probably where the line sits depends on which side of the transaction you're on, right? So it's very much a relative line. But I think either way, what we're talking about is using all of this flexibility to buy time, to be able to grow into a capital structure. If the economy remains strong and growth remains robust, to your point, 2 years from now, you end up in a place where you're better off. If it doesn't, your recovery rates end up being a lot lower. And I think that's the ends up being the trade-off. Those situations which don't work will have much lower recovery rates than we're used to using historical data because of the creativity and flexibility that we have in the system today to try to use all of these different techniques to buy yourself more time.
Okay, this is your chance to ask a question if you want to. This is a small room, so you can just raise your hand, or you can use the high-tech iPad if you want. Let me just pause and see if anybody has a question. Okay, so these people here at the Milken Institute, they have paid a lot of money to be here. And what they are looking for, ladies and gentlemen, is alpha. So I'm going to go down the line, and I'm going to ask you for your very best idea. This is not investment advice, of course, but just what do you want to share with this audience in terms of what you're excited about? What it can either be a sector or a strategy, or what you think is going to be good for the next, say, year or two.
Yeah, I'll give the same answer I gave last year, which didn't end up being right. But
Okay.
diversified fixed income, diversified credit with a higher quality tilt. I mean, we think eventually there will be more credit costs than there are now, but the power of carry and diversification is really significant. I was answering and referring to basically where would you invest, but the answer last year should have been equities or Bitcoin or really anything other than bonds. But we're now talking about strategies that you can put together with, in our opinion, relatively low fundamental credit risk and default risk that yield 6, 7, 8, even 9%. And if you're in an environment where you can realize that and you're regretting the decision, that's probably good for the rest of your portfolio. But we think that it has a blend of upside and kind of just baseline strong expected returns that historically would have been equated with taking a lot more risk. And it's not just the risk-free component. We think in securitized credit and some of the other smaller asset classes, you can still get a spread premium that's worth it to do the extra work.
Jean, what do you like out there?
Yeah, I think the pure direct lending is getting a little bit crowded. A lot of the LPs wants to put money into that, and the supply-demand dynamic. When you have too many people want to put money into that, spread compression, and you lose of the covenant. So, so in my view, it's like if you are not afraid of structural complexity, go a little bit on the complexity side of the structure, and then you actually might be able to get better fundamental quality in terms of credit, but take structure risk, complexity risk. And if you can structure it very well and you have good documentation around it, I think there are opportunities.
Yeah, that is interesting. If you want to do private credit, you can't have like 3 guys in a Bloomberg terminal. You have to have a proper, right?
And then you have to have a good
team
workout team. Yeah.
Right. Okay.
So I'm actually most excited about a strategy, which is for the first time that I can recall in 20 plus years of being around the corporate bond market, we're seeing a growth in systematic investing in corporate bonds, where they're able to take advantage of some of these new liquidity tools that I mentioned earlier, where you can transact at a portfolio level in a much more efficiently than you used to be able to transact at an individual bond level. And so we're seeing the first iterations of systematic credit investing, where it's almost like, again, back to the idea that we're looking more like the equity market, like what factor investing is for the equity market. We're starting to see that grow. In the credit market, Barclays actually has a partnership with State Street Global Advisors, where we provide a lot of IP for a suite of investment products built around that idea right now in the investment grade market. So I think it's an area that's brand new. It's growing. I think it's something that you certainly need to pay attention to, because just like even a fundamental investor in equities has to pay attention to what the quants are doing, even a fundamental investor in credit is going to have to start paying attention to what these strategies are doing. We're already having to pay attention to it in our trading desk because we're seeing these flows, and we have to understand why they're doing those flows, how sustained they are, what the depth of the market is. And so I think that's an area that is going to grow in attention, and I think is going to be something that people need to pay attention to.
Okay, Meghan?
Yeah, I mean, we're generally paid not to be optimistic about anything. So maybe I'll just from a sector perspective. I mean, we have an alternative investment manager with over $1 trillion of assets. There's others that are going to get there at some point. I think credit is going to drive the growth there, and ABF in particular is going to be a space to watch over the next couple of years.
Okay, we have 4 minutes left. That means 1 minute apiece. Starting with you, Meghan, do you have a piece of life advice for this room? This is going to be different than everybody else. Only this room will get this life advice. We're all very successful people. Give us some help.
Well, so my father was a high school English teacher for 49 years, and he loved his job. And so I think that's the biggest advice he ever gave me was, if you don't love what you're doing, you're going to be miserable for a really long period of time, potentially. So anytime we have a new joiner start, I tell them to be as selfish as possible before they start having, spouses, kids, buying a house, all that stuff. I mean, this is invest early and find out what you really like. It could be a sector or a pocket of what you're doing, but be as selfish as possible in the earliest years of your career and really try to, get as much time with senior people as you can.
Okay, Jeff.
I would say, and not to support our commercial real estate exposure, but I would say go to the office. And
Why is that?
And I heard that it was interesting because I was at an event, actually a real estate focused event, and so there was maybe more of an axe to grind. But it was at a university, and a graduating senior asked for advice, and that was the advice that he was given. And I think that when I think back to our 2020 cohort, we have 0% of them left in the bank. We were a name on a check. There was not a cultural connection. There was not a mentoring relationship or any sort of personal connectivity that we established. And I think, obviously we've come through that, but I think there's still at times this idea of the trade-off between being at home versus being at work. And I think the fundamentally being at work drives a level of connectivity and serendipity that's impossible to replicate.
Yeah. Jean.
I think I'm just very grateful that I get the opportunity to witness this whole change in transformation and growth of the private market. I'm just very thankful that I live in this era that I get to witness that. And then being grateful makes me feel like every day that you're more energetic and you're more want to know what's going on. Yeah.
So take the time to be grateful for things to be grateful for.
Yeah.
Is that the advice?
Yeah.
Okay.
Is there a lifelong membership to the Milken Institute? I would recommend you buying that. Any of you buying that? This is a great conference. I would say getting to know people outside of your line of business, which I think this conference does a good job of, and also taking a look at the other side of any thesis that you have. So we all challenge ourselves frequently in our investment views and the like. And so trying to better understand the other side of the coin, whether that's investments or politics or anything else.
All right. Before we end, Jean, I'm going to take an audience poll. You can reply by applause. I'm going to use an applause meter on how Steve did on this panel.
Wait.
And she's going to make an allocation decision based on your applause meter. So what is the view of Steve in particular?
Well, half the
on this
people in
panel?
here work for Guggenheim.
Okay. All right. Thank you so much, everybody. A terrific panel, and thank you so much for being here.
Thank you.
We hope you enjoyed the discussion. Please make your way to your next session.